Okay.
Awesome. Okay, so thank you so much for taking the time to meet with me today. I
Sure.
want to start by asking you who you are. I know you've been in this industry for more than you've been in TAB, so you've been here for 25 years, almost my age. Um,
Thanks for that.
so I just want to know, how did you get into this?
Yeah, when I started, got out of college, unfortunately, my dad didn't know anybody at ESPN, but he did know people at the CIT Group, which was one of the larger factoring companies in New York, and I was lucky enough to be selected for their management training program. So I actually, for the first year and a half, was engrossed in the business and learning the business before I actually had a real position in the company. So that was my start, and spent 4 years at CIT and moved along to other places. But that credit training was super valuable for the rest of my career.
Of course, I
Yeah.
bet it was.
Hmm.
Okay, awesome. What I want to talk about today, because you do have a long experience and you very well know lenders, founders, what the process looks like all the way around.
Sure.
I'm going to ask a couple of questions as if I was a borrower and
Okay.
things that I would like to know beforehand. I
Yeah.
know that a lot of founders listen to "you're not lender ready," and I myself has have been guilty of saying that a couple of times.
Sure. Yep.
But what does that really mean?
Yeah. It's a few things. I would say number one is accurate financial reporting. If a lender can't trust the numbers that they're given, then it's almost an immediate no. Keeping accurate books and records, having good collection practices, having good accounting practices is paramount because a lot of lenders trust the client for reporting, whether it's even invoice factoring to full asset-based lending. The lender is counting on the client to send in their reporting for borrowing bases, underwriting, and ongoing collections. So that is probably paramount. And then it's financial makeup. Nobody loves losses in continual losses with clients, but there's products for that. That's why factoring is around because it purchases the invoice and doesn't really have any effect on the cash flow of the company doesn't have any effect on the risk. As you get into higher end lending, like asset based lending or a bank line of credit, then profitability and cash flow matters because we're looking to see if the company has the debt service to make sure that we can get paid back in a timely manner, whether it's on a term loan or a revolving line of credit. The last thing a lender wants to do is to add to the losses that a client is experiencing. Because of the interest that we're charging. So those are probably the top two. And then, just it's funny. And then lastly is the character of the client itself, right? Background checks. Has there been fraud or bankruptcies in the past? And what does that look like?
Perfect.
Mhm.
And what are the things like if you have, so biggest red flag, and we always say it's have your financials clean, tidy, looking good.
Yeah.
But why would you say, or why would a lender say no to a great company that it's organized and in place? What are the biggest red flags once you're over that?
Yeah, I mean, background checks, just to give you an example, I had a client a couple of years ago, great profitability, great assets, everything was looking good. As we got deeper into underwriting, we did a KYC and did some background checks. It turns out that the principal had defrauded some banks in his home country,
Oh,
and apparently was still out on the lam, if you will, for it. So, character risk is number one. Could be industry, right? Sometimes there's flash in the pan industries. Things like oil and gas and trucking continue to go up and down in terms of the risk profiles. So, there's that. And, you know, for example, software companies right now are taking a hit because of all the AI is coming out.
yeah.
So, the question for a lender if a company is pristine is what's the viability of this company over the next few years that they're going to be around. And so that's certainly, if a company has pristine financials and good profitability, those are two things that I would look into for sure.
Awesome. And what are the things you think that a founder is going to think this is very important? I think lenders will care and lenders don't.
Oh, their sales pipeline of what's upcoming. I've seen pipelines. Oh, this client's 40% chance they sign, 80% chance these guys sign, which is great and shows that your salespeople are getting action. But, unless they're signed on the dotted line and you're getting business from them, we don't really care. Things like upcoming contracts or purchase orders that you need to execute on, that's documentation that we can hang our hat on and say, yes, there is growth coming. But, putting out sales pipelines or, hey, here's what we have coming up, we're in negotiations, so on and so forth. Everybody knows that the deal isn't closed until it's closed. And so that's something I see that's not terribly important, but good to know that they're active in the market.
Perfect. And what are the things that will tell you, this founder or this company, either or, it's going to be really hard to work with?
Yeah, ego, I would say, is number one.
Why am I not surprised?
A lot of founders, and rightly so, they have an ego saying, "Hey, I built this company. Look what I've done."
Yeah,
And they think that their product or service is the best thing since sliced bread, and it might be. But in the end of the day, the numbers tell the story. And if you're not profitable yet, if you don't have a path to profitability, if you have a product or service that you can't find a path to profitability with, you could have all the sales in the world, but you got to watch your P&L to make sure that what you're doing is going to earn you money. So ego is definitely number one. Also spreading themselves thin. A founder can take on many roles, and when they're at the point when they hire a real accountant, when they hire a salesperson, when they hire a real team, so there's less off their plate, is kind of where I pay attention. If they're trying to do it all, it's too much for one person, no matter how smart they are, and can get in the way for sure.
good. Do you have any story of a specific company that you loved and wanted to fund, but for one of
Mm.
these reasons was impossible to move forward? And were you able to
Hmm.
re-engage at some point?
Yeah, there was a company in LA that was a gaming company, and they had everything from software hosting to places where these gamers can come together, um, and also they had an esports arena, and they got paid up front. All the collateral looked great. um, I could not convince my head underwriter at the time that this was a growing sector of the economy, that esports is bigger than you think. Even if you don't play video games, it's out there and it's going to continually grow. And I couldn't get it done, and they went with somebody else, and I've been following them all along, and they just got sold for a significant amount of money, and the lender made out pretty well. They grew the business over 3 years, and I saw the lender post on LinkedIn of a success story they had. So that was a tough one, but hey, that was what, four or
Do
five
you
years
try to
ago.
keep in touch though with the
No, there's too much going on, and when they have a line of credit like that, it's usually sticky for a couple of years. And if you see articles of them growing and so on, they're probably going to move off of a non-bank lender to a bank or self-funded. So stuff like that. There are definitely other companies that I have been status quo and went with another lender over me, and I do check in probably 12 months later to see if they're still happy, if I can beat them in price. It's definitely something I follow up on, but you got to take your losses and move on to the next one sometimes.
and wish them good luck? Because
Yeah.
that was an awesome story for the
I,
founder, I'm pretty
yeah,
sure.
I have had people come back to me after they've made the wrong choices and say, "Hey, I should have went with you," and we worked that out. And I've also have clients that I've financed at different places over time, and will follow me to wherever I go. So,
That brings me to a question on relationship with lenders. Like
mhm.
lenders and borrowers do have a relationship and it's going to be ongoing.
Yep,
So what would you say are the best things to keep that really or to start that relationship in the right way? Maybe you're
yeah.
not going to let me today, but we might talk again in 6 months. So
Sure. I mean, for a borrower to a lender, it's honesty and transparency, right? We want to know the good, the bad, and the ugly and see if it's something we can help with because we have our standards. They don't change. So, to understand if we can do business together, super important. Otherwise, it's personality, really. You want to do business with people you like.
you like,
Sometimes people will pay extra to do it. And when you enter into a relationship, you're engrossed with this client and you're engrossed with this lender, and both businesses are dependent on each other. So, if you have a good relationship and you can call somebody up and they answer the phone and they're responsive and you generally like hearing from them, that to me is the ideal situation. Whether you're talking about sports or kids or vacations, it's always nice to have a personality along with the client that you're doing business with.
perfect.
Yeah.
And is there like a moment to start that relationship? Like if I'm not looking for capital right now, but I know that I might in the future, should I be starting those conversations or is there a specific moment where I should be saying, okay, this is time. I should be sending
Yeah,
Aaron an email.
it can't hurt. I mean, it's always good to know the lay of the land of the industry you're getting into. The capabilities of each lender and what you're going to need are super important. And while one lender says that they do asset-based lending or factoring, they might be higher priced. They might do, their tolerance for deal size might be smaller than you need. So, I think always um, it's always good to ask the right questions and get in front of it. If you're looking to buy a car, you're going to do your research of what you need out of that car. So, never hurts to do that from a lender and to start the relationship. You can quickly, also understand who you might want to do business with and who you might not. And then you also get the time frame to get started.
Cool. Thank you
Yeah.
so much for all this information. I have a quick fire round that I prepared.
Okay. Let's do it. I'm
Let's
ready.
see how we can go as fast as we can. What
Sure.
would you say is the most underrated metric?
For credit,
Hmm.
the most underrated metric for is probably uh obligor credit. Who's paying the bills, right? It is hard to find that information, especially with private companies. And you can have all the receivables in the world, all the assets in the world, but if they are from risky companies, it is a non-starter for a lot of lenders.
Perfect.
Yeah.
Biggest myth founders believe about lenders.
We're out to get you. While we do protect our own capital, we really truly want to see clients grow. For us on the non-bank side of things, a client using our capital to grow and get to the next level and leave us for a bank at a cheaper price and probably an easier transaction is a win for us.
Yeah, of course. I hate the fact that the word debt has such a negative connotation
Sure.
to it because you really need debt at some point. So the
We
debt, no
do.
thanks, it's not really
Right.
applying to everyone.
Hmm.
As is like I'm here to see you grow, and I would
That's it.
love to continue this conversation with you as you grow.
Absolutely.
Because
I've
if
had a
you
lot.
have a better business, I'll have a better business. But
That's
yeah,
right. I have a lot
yours
of
too.
success stories who have moved on to banks and have done so successfully. I have a couple who have sold their business as well. So,
Yeah.
whatever the end game that you're looking for, somebody like us is a big help.
Awesome. One thing every founder should do before seeking financing.
Get your numbers in order. Uh, just make sure that the information that you're sending to people is right and accurate, and that it's repetitive going forward, and you have the right systems in place. Again, there's a decent amount of trust that we put in the borrower that they're keeping track of their stuff and what they're sending to us is accurate. We will do audits, but we want transparency. If there's an issue with the company, we want you to tell us so we can get ahead of it and help you through it rather than it being sprung on us at a later time where it's harder to help.
Absolutely. Yeah. Always start with the negative. Like, this
Yep.
is something we should be working on. How can we work on, let's get some actionables on this and not be scared of it coming up later, because it
and
will.
most of the, and most of the time it's stuff that lenders have seen before, and they're familiar with it and they have solutions. So being upfront about the negatives is pretty big.
I totally agree.
Yeah.
And the last one thing every founder should stop doing immediately.
Oh boy. um I would say looking for too much equity. You built your company, you worked hard to get it to where it is, and a lot of startups are looking for big rounds, big numbers, and you're giving away ownership, and depending on how much ownership you're giving away, you could potentially be giving away decision making. And it's your company, you built it. I would say look towards the debt markets before you start to sell away part of your company. Equity is sexy, and having partners that come in with the equity is sexy, but you built your business, and you want to maintain control and you want to maintain ownership and get rewarded for your hard work. So, I would say, look towards the debt markets earlier before adding more equity into the business.
I love that. I
Hmm.
love that because equity is necessary
Yep,
sometimes,
absolutely.
but not all the times.
No,
And debt is not bad.
that's right. It's
It's
not at
bad
all.
sometimes, depends on what you're doing, but
Sure.
perfect. I love that. Thank you so much